After a strong rally this spring, the U.S. stock market has given back gains as signs for the economic outlook are flashing yellow. U.S. manufacturing, which had remained resilient for the first half of the year, has weakened in the face of a slowing global economy as Europe continues to struggle with debt woes and growth in China slows. Other economic indicators that have turned lower: consumer confidence and retail sales. Plus, unemployment remains stubbornly high. And to top it all off, earnings growth is decelerating. The one relative positive, the housing market may have finally bottomed. So what does the second half of the year hold? Here to give us their outlook for the market and where to invest accordingly are Doug Roberts, Chief Investment Strategist for Channel Capital Research and author of Follow the Fed, and Rex Macey, Chief Investment Officer for Wilmington Trust. Gentlemen, welcome.
Thank you for having us here.
Doug, let me start with you. What's your outlook for the market for the second half of the year?
Right now it's uncertain, but I think, as long as the Fed repeats the pattern that it's had for the last 2 years of injecting quantitative easing or some form of monetary stimulus quite aggressively during the second half, we should have some type of a rebound. But we won't get a rebound until the Fed really does this type of activity. And also, it will be highly dependent upon whether they do it aggressively enough. We have severe problems around the world, such as what you're seeing in Europe, China, and also in the Middle East. At this point, at least in the short term, the Fed can neutralize these threats, at least enough to inflate asset values. It may not really do too much for the economy, but they can keep the markets up. But at that point, it may require another dose of QE3.
Rex, has the market seen its highs for the year, especially given that warmer weather earlier in the year may have pulled economic activity forward?
It may have. I mean, I wouldn't say it's the weather that caused such a good first quarter that the rest of the year will suffer. Mm-hmm. It's really the problems that's already been mentioned, plus, importantly, the prospects of a fiscal cliff in 2013. You have the expiration of the Bush tax cuts, you have automatic cuts in spending, extended unemployment insurance, the health care tax comes into effect. A lot of things would be contractionary in the U.S. in the absence of congressional action.
So given that, do you expect politics will derail this market later in the year? What is your outlook for the second half?
Well, politics are derailing the markets now. We will see what happens as we move into the year. One of the things that we're keeping an eye on is the debt ceiling. It looks to us like we will approach the debt ceiling limit in the latter half of September. There are a few things the government can do to sort of postpone that, but we may come down to another debt ceiling debate before the end of the year, and it would not surprise us if that forces the hand of Congress to take some action, which may provide some clarity for 2013 and may, in fact, help things out by the end of the year.
Doug, do you expect volatility to pick back up as we head through the remainder of the year?
Yeah, I think at this point you seem to, in the words of the immortal Yogi Berra, it's deja vu all over again. We seem to be following a similar pattern where the stimulus is starting to wear off. Part of that was accentuated by the good weather. And right now we need another dose, otherwise volatility will increase until we get that stimulus. Essentially, government, whether it be monetary or fiscal, is now lender and spender of last resort. The cycle that we had during the 90s, where basically the Fed and the government actually primed the pump, launched an initial degree of stimulus, then the economy took over, is non-existent right now. The markets go up, the economy recovers briefly, as long as there's sufficient stimulus. Once that stimulus wears off, then at that point, we tend to go back down. I think Rex is correct also that the overhang really with some of the expirations of the Bush tax cuts and other fiscal stimulus is also quite important. And it will require at the very least some type of kick the can down the road measure by Congress and the administration to at least postpone the inevitable of dealing with these problems.
Doug, have markets discounted the Fed policy?
Right now, they're discounting it, but it's a question of really whether they're discounting the degree. They're assuming that there'll be some type of stimulus, but it will not be substantial. But the real question becomes: is that may be enough let's say, sometimes what the Fed has been able to do is essentially talk the market up. They've been able to come back in and really almost engineer a trading range where when the market starts to sell off, they say if things get much worse, we'll be in there and we have your back. The so-called redo of the Fed put that we had in the early 2000s and the late 1990s. However, they haven't really taken substantial action. That seems to be enough in the current economy as long as we, in essence, on the fiscal side, don't fall off the cliff and don't have a geopolitical event which causes ripple effects and widespread loss of confidence in the financial system.
Rex, what are your expectations for Fed policy, and what does it mean for Treasury yields?
We expect the Fed to be easy for a long period of time, especially given the global weakness we're seeing. We've got the problems in Europe. Keep in mind that Europe accounts for 20% of China's exports. China's not looking all that strong to begin with. With the weakness in Europe, China becomes a concern. Plus the fiscal cliff in the US, we see no reason for the Fed to do anything other than ease or continue their easy monetary policy. So we think they're going to be easy. The question is whether credit will be easy enough and have an effect on the economy.
One thing, we're getting a little bit more micro, one thing that's really worried me over the past couple of years is profit margins. And I've really been surprised to the extent that companies have been able to boost profit margins through cost cutting and really anemic revenue growth. So, Doug, have you been surprised by the resiliency of profit margins, and how long before they peak?
At this point, I mean, if you look at it, the monetary stimulus, the degree of stimulus in general, has benefited companies with access to the public markets. This has allowed a lot of the companies to substantially refinance at lower rates. That actually helps profit margins and has a ripple effect throughout the economy. One of the things that, for instance, we're talking about with manufacturing that nobody's really talking about is much of the recent manufacturing renaissance in the United States can be attributed to the accelerated depreciation provisions from the stimulus bill passed much earlier. And that was really 100% depreciation of new equipment last year and 50% this year. That tends to disappear along with some of the other programs. So I think the closer we get to the end of the year, the more and more the market is going to start discounting the end of stimulus and look for an additional round, either in the form of fiscal or monetary or both. And that becomes the key problem.
Rex, what's your outlook for corporate earnings, and how does that factor into the market's valuation right now?
Great question. We've got an estimate for 2013. We still have 108, though we're watching the numbers carefully. We're staying with 108. You mentioned volatility earlier. What our concern is if we smell a whiff of recession, the market's going to get very volatile because earnings are going to swing from growth to falling, and that's going to have a big impact on the market psychology and on valuations. So we think markets could get very volatile if they think there's the possibility of recession later in the year.
Doug, where are you advising clients put their money right now?
Right now, I think you have to have a balanced portfolio because right now, if there's stimulus, you're not really sure how it can affect the markets and versus the economy. So at this point, you want to have a strategy in place that manages your risk profile, and then at that point, stick to that strategy. With regard to some of our own models, we're saying that we're in an easy money environment and that eventually the Fed will be forced to stimulate, and that will favor small cap stocks over large cap stocks and gold over treasury bonds. The only danger becomes is if we get back into 2008, where the Fed doesn't move aggressively enough and we fall into a period of deflation briefly, in which case you want to be in probably safe assets.
Would you be willing to venture some ETFs?
Well, for instance, for large stocks we like them big and liquid. For instance, large stocks as a proxy for that would use the S&P 500, the spiders. For basically small stocks, the S&P 600, the IJRs, and for gold, the GLDs, and also for bonds, either the TLTs or the IEIs, depending upon whether you want to go longer or shorter.
Rex, where are you advising clients put their money for the second half of the year?
Well, we're slightly cautious. We're looking for some buying opportunities as the market drops. We thought the market might get weak. That seems to be coming to pass. So we are slightly underweight our normal equity targets. We do have an overweight within the fixed income sector of what we call spread product. These are high yield corporates, floating rate notes, and anything that gives you a little more yield without extending your duration. So that's where we are now, but we would be looking on further weakness to be increasing our equity exposures.
Would you be willing to venture some names on the equity side?
Sure. We on the ETF side, we're using a little bit of a tilt to growth within the domestic space and the international space. So we will use the Russell 1000, Russell 2000 growth kind of ETFs. We use EFA for some of the international. We use a Vanguard ETF for some of the emerging market exposure. Those are some of the names that we're using on a broad basis.
All right, gentlemen, thanks so much to both of you for coming on. I appreciate your insight.
Thank you.
Thank you for having us on.